Good afternoon. Thank you so much for joining our webinar today. While we're waiting to get started, you can go ahead and connect your audio. We recommend listening to the audio through the computer. You can also go ahead and download the handouts. They're available in the handouts pod. You can just click on that file and download it, and we'll get started in about 5 minutes. We have just a few more minutes before we get started, but while you wait today, you can go ahead and get your audio connected. You can listen through the computer or through the phone, whichever you prefer. We also have a handout that's available for you in the handouts pod. You can just click on that file and download and save it to your computer. And we'll get started in just a minute. All right, good afternoon, everyone. My name is Morgan McLeaf. I'm a learning specialist here at Cherry Beckert. We really appreciate you tuning in for this afternoon's webinar. I have just a few quick housekeeping announcements before we get started. First of all, you can connect your audio. You can listen through the computer or through the phone. You can choose which audio option you'd like under the audio tab. To earn CPE for today's webinar, please be sure to answer the polling questions. Make sure you click the submit button to submit your answer. We will remind you as the polls pop up to go ahead and answer those. You can also submit any questions that you may have in the questions pod, and we will try to get to them throughout the webinar. Finally, at the end of the webinar, you'll receive an evaluation. If you could complete that and give us your honest and candid feedback, we would really appreciate it. That's all for housekeeping, and I'll turn it over to our instructors.
Good afternoon, everyone. This is Sarah McGregor. I will be your host for today's presentation, all about how tech companies can keep up with the sales tax whirlwind. A lot has happened in the area of sales tax, and it has a special impact to companies that are in the technology space. And we wanted to focus on that today. So today we have Lauren Stinson, who is our national leader for sales and use tax services. She'll be speaking to us. Kathleen Holston is a director in our state and local tax services group. And Nellie Vigneron, she's a manager in our sales and use tax team. All three of these professionals bring a wealth of experience, years of experience, excitement about this area, and just I am amazed every time I listen to them at the complexity that they're having to deal with the new sales and use tax rules. We've got a lot to cover today. We're going to do a brief overview of where we've come from and why we're having so many changes in sales tax due to the Wayfair decision of the Supreme Court, and some special rules about how it applies to technology companies. And then we're going to wrap up with what to anticipate next and some recommended steps for you as well. But before we get to all of that, we wanted to bring you a word from Michael Valerio, who is our managing partner for our Atlanta and Georgia practices. And he's also our industry leader for technology. So Michael, welcome to the broadcast.
Thank you, Sarah. As she said, my name is Michael Valerio. I'm a partner in our Atlanta office and the firm's technology leader. I want to welcome everyone to today's webinar on how tech companies can keep up with the whirlwind here. As Sarah noted, the sales tax topic has been a hot one over the last few years, and state laws have been changing. Every month there's a change from some sort of state, and so those of you who may have attended a previous webinar may not know that there's been a lot of changes in the last year or two. States are getting more aggressive to find revenue, and technology companies have been specifically targeted to get that revenue. In addition, we've noted that sales tax issues really is the #1 item that comes up in an M&A transaction. And so we don't want to see transactions held up from your businesses from a timing perspective, or amounts that just get held in escrow just to resolve that compliance. So if you have any further questions at the conclusion of the webinar, please let us know how Cherry Beckert can help you with your sales tax compliance needs, and we look forward to assisting you. With that, I'm going to pass it to Nellie to get the presentation started.
Hello, good afternoon, everyone. This is Nellie Vigneron, and we're going to kick off this webinar with some basic concepts and definitions. The first slide, Sarah, if you can, thank you. It's on sales tax and use tax. Just wanted to give you an overview of the basics. So what is sales tax? What is use tax? Sales tax is a tax imposed on taxable tangible personal property and some enumerated services. It is collected and remitted by the seller. Use tax, on the other hand, is a self-imposed tax upon the purchase and the use of taxable items. Use tax is the purchaser's responsibility, and it is to be remitted directly to the state. Now let's take a look at Nexus. As many of you know, The world of sales tax has changed significantly since the June 2018 Supreme Court ruling. Prior to the ruling, physical presence was the determining factor as to where a business had sales tax obligations. Some examples of physical presence are offices, employees, trade show attendants, sales rep, soliciting sales within a state, affiliate nexus, as well as having inventory within a state. All these will trigger physical nexus. The Supreme Court ruling of June 2016, South Dakota versus Wayfair, has changed it all, really. And the tech company has been one of the most affected industry. The clear result of this ruling is physical presence is no longer the only factor in triggering nexus. Economic nexus, selling into a state above a certain threshold, now can trigger nexus. As of today, Sarah, can you go back one more slide? Sorry. As of today, more than 40 states have passed economic nexus laws. Most states are adopting a $100,000 threshold or 200 transaction. And the 200 transaction threshold is really not that unrealistic and can be met really easily. Some states have higher thresholds than others, California, Texas, Tennessee, just to name a few. Others have no threshold at all, which is the only state is Kansas. One sale into the state will give you economic nexus. What's interesting about this slide is 28 of these states enforce the transaction threshold, and states like Arizona are actually reducing their threshold from $150,000 to $100,000 in 2021. So this chart is consistently changing, consistently evolving. States, it's not static. States are changing and updating their rules constantly. On the next slide, the map represents, it's really a visual representation of which state have adopted economic nexus, marketplace facilitator laws, or have not adopted either. Things to note here is Georgia will become green as of April 2020. Also, Kansas is, there's legislation for Kansas to adopt marketplace facilitator laws. So Kansas may change in the future and become green as well. So how does this apply to the tech industry when it comes to transaction count? How do you know what makes up one transaction? Usually we see it as one invoice equal one transaction. If a single user is paying monthly over a year, that would equate to 12 transactions for that year. If a company has 10 different users and paying a monthly fee, then that will be 120 transactions per year. There are also other complexities to take into account when trying to determine nexus. Some states are looking at the calendar year in order to determine if nexus threshold has been met. Other states will just look at the previous year. Other states will look at the last 12 months. So it all changes on a state-to-state basis. What about the threshold amount? If you're selling taxable SaaS into a state, as well as professional services such as training and implementation, what revenue will be included in the nexus threshold? Will you include the taxable SaaS number only, or also the training and implementation revenue, which is most likely a non-taxable service? Also, who to count? You have states such as California, Virginia, and Arizona that will count within the nexus threshold any related entities that you may have. So all these complexities, Nexus on its own is is complex, but even more complex when it comes to the technology space.
All right, I think that brings us to our first polling question. Here we go. The poll is now open. With economic nexus, a business can have nexus with a taxing state just by having a minimum number of sales transactions in that state. True, false, or not sure. There is no right or wrong answer for you. We are getting your opinion here. If you answer not sure, that counts for your attendance, just the same as if you answer true or false. So that's the question. With economic nexus, a business can have nexus with a taxing state just by having a minimum number of sale transactions in that state. We'll leave that up for just a moment. And I think we have a question. Kathleen, did you want to take a look at that question that's come in?
Just looking at it now, is the question just meant to say if the sales are not subject to tax? I'm going to base it on that assumption.
Yes. All right. I think we'll give just another second here to take a look at the poll. And hopefully we've got everybody responding there. And Morgan, let's go ahead and close that poll. All right. Lauren, talk to us about how aging tax laws are impacting with emerging technologies.
Sure, thanks. Thanks, Sarah. So as Nelly's just explained, most tech companies are now faced with having to juggle sales tax obligations in multiple states because of Wayfair. And if every state had the same definition and the same laws around taxability, it wouldn't be that hard. Unfortunately, really nothing could be farther from the truth. So one of the biggest challenges that we have when we start looking at the taxability of products and services is that we're forced to look at the old tax laws with new and emerging technologies. So if you think about it, the majority of state sales tax laws that we have were written many years ago when the basis of sales tax was really based on the sale of tangible personal property. But now think about today. Think about all the new technology that we have, even that we didn't have 10 years ago. You know, it's amazing. Life before we could use apps to pay people and order groceries and share photos and software to control the lights in your house and stream TVs and movies on demand. This is our new reality, and very little of it has anything to do with the sale of tangible personal property. And that's where the taxability and technology issues become really problematic, trying to match those up. So let's first take a look at the taxability of software. And how software is delivered makes the world of difference. So first, we're going to go old school, pre-written tangible software. This is software that comes with a DVD, a flash drive, with backups, with user manuals. In this case, the seller is delivering something tangible to the buyer. It fits neatly into that old school definition of the sale of tangible personal property. Most states will tax this unless a particular exemption applies. Now, fast forward, and now software providers have the capability of electronically downloading software. It can either be downloaded over the internet, or it can even be through a concept called load and leave, where the software provider essentially loads the software and leaves and takes everything tangible with them and leaves nothing tangible behind. So then that begs the question, is the software still considered to be tangible personal property? And this is where you start getting some deviations from states. Some states will say that the software is still tangible, where other states will say that it is intangible. But even if the states consider it to be intangible, many states have slowly begun adopting laws expressly taxing even electronically downloaded software. Currently, there are more than 30 states that tax electronically downloaded software. So moving to the third category is custom software. And custom software it's defined to be software that's written to the particular user of one company. And selling it to more than one company precludes it from actually being customized software. And as such, it's considered to be more of a service transaction and generally not subject to tax. However, we are starting to see changes in this area as well. And then finally, the last category, and the one that we're seeing more and more frequently, is software as a service. Under a SaaS model, the software is not delivered to the customer, but remains with the seller, and the customers are provided the service to remotely access the software. In this case, the software is not transferred, which is why some states have had, they've had to take the approach that it is actually a taxable service in order to impose taxation on software as a service. Currently, software as a service is taxed in about 20 states, and that number is quickly growing. So I usually like to look at the 4 biggest states: California, Texas, Florida, and New York. They're the biggest states, and they're generally the trend-setting states. See, what they're doing to see if that gives us any insight. Unfortunately, it doesn't give us a whole lot in this case. California and Florida, neither one of those states tax either electronically downloaded software or software as a service, whereas New York and Texas tax both. Then, there are some states that do provide some unique exemptions and reduced rates to software that's used in a particular context. And usually, these type of exemptions lend towards more kind of economic development, trying to encourage businesses to come in their state, or more to provide a business-friendly environment. So Connecticut, they have provided a reduced rate of tax of 1% for electronically downloaded software and SaaS that's sold to a business. Iowa has a similar, it's a full exemption, not a reduced rate, but SaaS sold to commercial enterprises as long as it's used in the ordinary course of business. Same thing with New Jersey on electronically downloaded software. North Carolina provides an exemption for software, any kind of software that's running on a business enterprise server. And then, one thing that's just very unique is Texas. Texas has a lot of laws around, technology and technology services. And interesting, they consider SaaS to be a data processing service, and only 80% of the value is subject to tax. So another area that it's really important to consider, especially if you're in the environment of selling software, is how the concept of software maintenance is treated. There are a lot of variations on how states treat software maintenance, but essentially most lay out some factors that really heavily influence the taxability. So what is the true intent of the software maintenance agreement? What is the true intent? Is it for software? Is it for support, or is it for the software upgrades or updates? Another factor is the software, is the maintenance agreement bundled with the price of the software, or is it a standalone price? A lot of states factor on whether or not it's an optional purchase, or do you have to buy the software maintenance as part of the sale of the software, or as part of the purchase of the software. And what these questions are really trying to get at is, what is the maintenance for? Is it the continuing functioning of the software, which is often taxable, or is it true support, which is often non-taxable, or a combination of both? And just to kind of illustrate this, I wanted to compare a couple southeastern states. So Georgia states that separately stated software maintenance agreements that include updates and upgrades and support are taxable at 50%. But if no support is given, it's 100% taxable. And if it's only support, it's not taxable at all. So you can really see that they're trying to get at the very nature of what is being provided by that maintenance agreement. Whereas to compare it to the next door neighbor, North Carolina takes a little bit broader approach, and they say that all software agreements that provide updates and upgrades and support are 100% taxable. So you can see that there's a lot of variations of things that can affect whether or not maintenance is taxable or not taxable in a particular state. So in addition to software maintenance, many tech companies also provide ancillary services that are sold in conjunction with software, such as programming or installation, implementation and training, and the list kind of goes on. So most states tend not to tax these services unless they're listed as a specifically taxed service in that state, which is fine, but that list of tax services in each state seems to be growing longer and longer by the day. So if you're a tech company or you're a software company and you provide ancillary services such as these, some key elements really to understand is, one, is this service a tax service in the state in which you're delivering it? Are they optional or mandatory from the sale of the software, especially where the software was taxed? And where are the services being performed, and where is the benefit of the service? So it's very important that you separate the non-taxable services from the separately priced. Let me clarify that. It's very important that the non-taxable services are separately priced and separately stated from the tax products and services. So what you don't want to do is you don't want to bundle taxable items and non-taxable items together, because bundling them together can taint the transaction and cause the entire transaction to be subject to tax. Okay, so now let's focus our attention a little bit on digital products. So digital products are non-physical electronic products that are transferred electronically to the customer. So some products may seem easy to categorize, like books and movies and music, but other digital goods aren't so easy. For example, a virtual learning style class. Is that a digital good, or is that a professional service? And what if it's live, or what if it's been recorded? And what if there's not a permanent right to have access to attend that class or watch that class? In some states, all these different criteria make a very big difference. Another issue that really arrives around digital products is, and if we can go back one slide here, not quite to data processing yet, but really around the common definitions for digital goods. So some states have their own definition. Some states, some states have common definitions that are similar to some 20 states or so. Some states have their own definitions, and some states don't actually have any definitions at all, which really makes multi-state tax compliance very challenging. So currently about half the states tax digital goods in some way, shape, or form. The other half don't. And the inconsistency around the taxation makes it all the more challenging to be in compliance, and especially in these days when states are kind of cash strapped, this is an area that they're really looking to pick up to bring in more and more revenue. And then the last topic that I just want to kind of briefly talk about is data processing and information services. And these services generally involve the compilation of information or the processing of information. Data processing usually focuses on services around the customer's data. And Texas is a good example of a state that taxes data processing. And this can look like manipulating client data or producing reports from clients' data. to really kind of bigger stretches of the imagination, like creating web home pages or selling software as a service. Information services, on the other hand, focus more on gathering and maintaining data or selling that service, such as financial market reports or stock quotations or newsletters. Now, if your company is in the digital marketing space, it's a little naive to think that your company is only providing a non-taxable professional service. Depending on what that service is, it can potentially be crossing the line into a taxable service. So, especially in the space where information services and digital processing may be bundled with other services or maybe bundled with software, it's really important to get granular with your company's fact pattern and the specific state laws where your customers sit. This is really the only way to stay out of trouble. So I know I've mentioned rapidly changing and inconsistent and fact pattern oriented, and depends on the state many times when talking about taxability issues. But really that's the message that I want to convey to you, that taxability for the tech industry is very complicated and it's rapidly changing, and the importance of getting help shouldn't really be minimized or put on the back burner. I think that leads us to our next polling question.
It does. Thank you, Lauren, for that. So really figuring out what category of good or service you're providing is important to figuring out then what are the tax rules for related to that product or service. So we are at our second polling question. Whether a sale of software is subject to sales tax may depend on how the software is delivered to the customer. True, false, or not sure. As Lauren mentioned early on, the traditional method was, did it travel on a piece of tangible property, a disk or a flash drive, or heaven forbid, a floppy disk or a CD. And now, again, it's delivered in so many different ways or different formats that it's hard to tell, but it could definitely influence whether that software may be subject to tax in a particular state. So that is polling question number 2. I wanted to get back and make sure, Kathleen, for the listening audience and for the recording, I'm going to ask this question and that you provided an answer to, or would you like to wait and answer that question in your discussion on compliance issues?
I can answer it now.
Okay, so the question is, go ahead.
No, go ahead.
If you have enough sales to create an economic nexus with the state, do you still have to register even if those sales are not subject to sales tax in that state?
Sarah, like most things in sales tax, it will depend on the state. Some states base their sales tax threshold on gross sales or total sales, while others base their economic nexus threshold on taxable sales. So it's really important to check the specific state provisions to find out which way they go with this. If the state's threshold is based on total sales, then nexus is triggered even if some of those total sales are not taxable. There are some states that provide an exception whereby a seller that doesn't have any taxable sales isn't going to be required to file a return, but most states still do require the filing of a zero return. So again, another area where you need to check the specific provisions.
Great. All right. Morgan, I think we've had enough time now on polling question number 2 to give people a chance to answer. So we will move back on to the next discussion, which is all about sourcing sales.
Hello and happy Mardi Gras Day. Thank you for spending it with us. My name is Kathleen Holston, and I'm going to talk about sourcing for sales tax, or in other words, where do you collect the tax? Now that might seem straightforward, but as you've probably begun to realize from everything we've talked about so far today, it can be quite complex. If your product is deemed taxable, the next important consideration is to identify which state you need to collect tax in. But due to differences in state tax rates and how states tax technology products, sourcing can significantly impact your tax liability. So let's talk about sourcing. Well, first of all, sales tax is destination based. What does that mean? Well, it means taxes due based on where the product is delivered. Well, if the purchaser then uses the product in another state, let's say in a traditional tangible personal property sale, then most states deal with this via granting a credit for the tax paid to the original state directly to the purchaser, but don't use an apportionment like those of you who have been in income tax are used to seeing, whereby you apportion revenue among the various states. They usually use a credit mechanism. However, when you're not dealing in tangible personal property, but you're dealing in the technology business, the unique issues arise in the technology sector. Electronically delivered software and cloud services typically are sourced based on delivery location, location of use, or the location where the benefit of the service is received. But the devil is in the details as to how that is defined. And it also may be very different from the customer's billing address. So this presents both conceptual and logistical issues for the seller. Let's discuss why on the next slide. When a seller of tangible personal property invoices a customer, as I'd mentioned, the destination jurisdiction used for sales tax purposes typically is the ship-to address shown on the invoice. So it typically is much more straightforward. However, technology products often lack physical delivery and may be accessed and used concurrently in multiple jurisdictions. Just FYI, this is often called multiple points of use, or MPU. So how do you source technology products? And can your billing system accomplish this? Well, the default for a typical billing system is to source the sales of services or technology products based on customer billing address. That's usually how most billing systems are set up. And if you were to run a sales report from your billing system today, you'd probably get sales sourced by state based on the billing address of the customer. And that is if the customer location data is even captured at all by your system. Many taxpayers, especially in the technology space, struggle with the fact that their billing system doesn't even capture location data. So this presents some significant challenges and perhaps some opportunities for sales tax compliance in the technology business. Absent data regarding the location of use, sellers typically default to charging tax based on the customer's billing address because that's what comes out of their system. But what alternatives does a seller have? A few states allow the purchaser to provide what's called a multiple points of use exemption certificate. Now, this really isn't an exemption per se. It's really similar to a direct pay permit, if you've heard of a direct pay permit. Basically, because it relieves the seller of the obligation to collect that state's sales tax, and the purchaser then takes on the responsibility of directly remitting use tax to the state where they use the product. So the seller takes the MPU exemption certificate from the purchaser. The seller is relieved of the requirement to charge tax, and then the purchaser then has to determine the sourcing of its use of that product and allocate it in some reasonable manner among the states where it uses the product. And I think that's a key aspect of multiple points of use. The purchaser has to use some reasonable method to apportion the charge among many locations where it may use its product, and it may have concurrent users in several states across the nation. Now, unfortunately, only a few states have an MPU certificate. Some examples are Ohio, Minnesota, Massachusetts, and Washington. That's not many states. The large majority do not yet have an MPU exemption certificate. So where does that leave the seller? Next slide, please. Well, the seller has a couple of options. Some states that don't have an MPU, quote, exemption certificate do allow sellers to apportion the sales charge for a product with multiple points of use based on the location data provided by the purchaser. So the seller would go to the purchaser and obtain location data in order to allocate among the various points of concurrent use of the purchaser's employees or users. A typical apportionment method might be the number of users at each location, or perhaps the level of usage at each location. For example, data usage, output volume, usage minutes, or something similar, or any other reasonable method that is based on data in the normal course of the seller and purchaser's business. However, a significant issue for sellers in these states is supporting the allocation used. If the seller apportions its charge to the purchaser based on multiple points of use data, the seller takes on some level of risk of the state not accepting the allocation that's used. States differ widely on the type of detail level of the type of detail and the level of data required to support the allocation among the various user states. And it seems like these requirements are continuing to evolve. For example, New York requires a signed statement listing employee names and complete address locations. Pennsylvania has evolved its requirements over time, requiring everything from just user names and locations to user titles, whether the user has a laptop or a desktop, because a desktop is stationary and a laptop can be moved from a location to location. So the states are evolving how and what they're going to accept when it comes to supporting an allocation of multiple points of use, and in many cases, this leaves the seller at risk. Another issue that a seller has to deal with is how often must the allocation be updated? Is it annually? Is annually sufficient? Is more often required if there are significant changes in where the users are located? And how does the seller's billing system invoice the allocated charge? This often requires manually creating separate invoice lines by location, which can be very time-consuming in your billing process. The slide with the MPU example. Thanks. Okay, so you're probably thinking, wow, this seems very complicated and risky from a seller's standpoint. Why should I consider apportioning my sales based on my customer's user location? Well, the result could have a significant impact for you and for your customer, and it could be a great customer relations issue. Let's look at this example here on this slide. If you have a vendor and selling to a customer in a state with a 9% tax rate, but the customer's employees actually use the product in 3 different states, 2 of which have lower tax rates, and 1 of which doesn't even tax the product at all. Well, looking at this example, if instead of sourcing the entire sale to the customer's headquarters state at a 9% rate, if the vendor instead obtains user location data from this customer and allocates based on the actual user locations, it's saving anywhere from 9% to 2% on the sales tax imposed on that purchase. So you can see it can have a huge impact. So it is something that you want to try to do and try to offer to your customers if at all possible. Now, what are some best practices in order to do this? Best practices for sellers to structure their sales contracts to capture user locations and also to document procedures for timing and user location allocations for sales tax billing and reporting purposes. So put it in the contract, spell out what it is that you're going to receive from the customer that's going to back up the user location allocations. How often is it going to be updated? Another typical contract term around multiple points of use is holding the purchaser contractually responsible for user allocation data in the event of a sales tax audit. Okay, next slide. What if I don't have user location data? We realize that some technology companies have absolutely no data regarding user locations and may not have any way of obtaining that data. For example, you may have individual users using PayPal and the vendor doesn't, you as a seller don't receive user location data. How can sellers like this source sales in order to charge sales tax, the correct sales tax? Well, many states apply a sourcing hierarchy, which basically was originally envisioned by something called the Streamlined Sales and Use Tax Agreement, which, to put it succinctly, is a group of member states that are joining together to simplify sales tax administration. It was created several years ago in the hopes of getting Congress to overturn Quill, which, as we know, ultimately happened in Wayfair. This particular group has a lot of guidance, and its member states have promulgated certain guidance and certain simplification for administration of sales and use tax. And the sourcing hierarchy recommended by the Streamlined Sales Tax Agreement and used by a lot of states is that first you look to the location of the purchaser's receipt of the product, if it's known to the seller. Next, you look for the customer's address available from the seller's books and records. If you don't have that, then the next thing you look to is the customer's address obtained at the time of sale, including the address of the payment instrument. Oftentimes you have a billing address on a credit card, on credit card information. If none of those things can be obtained by the seller, then the location from which the product was shipped or first made available for electronic delivery is where you would look. Now that could either be the seller's location, it could be the location of the server that transmits the product or the server that hosts the product, but be careful, it must be something that is reasonable and normal course. So you can't be manipulating the location by not gathering data or not looking for or surfacing the data that would normally be gathered in the normal course in order to force the hierarchy down to the last item, which is your origin location. So you have to be careful. You have to exercise a certain level of due diligence in order to surface the right sourcing data. So as you can see, sourcing for sales tax can be very complicated.
Great. Kathleen, before we move into remediation and you talk to us about how to fix problems, could you go back over those 5 states that have MPU certificates again? We had a question follow up on that.
Absolutely. Ohio, Minnesota, Massachusetts, and Washington.
That's 4 states that have it currently.
That's okay.
All right. So we've talked about a lot of complex issues about collecting on the front end. What if we haven't done a good job of collecting on the front end? What do we do now?
Yeah, so far we've covered Nexus, taxability, sourcing, and like you mentioned, the next important topic is registration and remediation. So once a company has identified a Nexus footprint and whether or not their product and services are taxable, it's time to register. And the Nexus effective date is the registration date from when a business should have started collecting and remitting tax to the various state. With all of the changes in sales tax, more likely than not, the effective Nexus date is in prior period, leaving many companies and taxpayers with historical liabilities that they have to handle. Companies really have 2 choices. One, they can file prospectively as of today and start collecting and remitting, which in essence will not handle any historical liability. And also it is not something that we recommend. And the second option is to, in fact, address these historical liabilities and register use the Nexus effective date, which is the date when they first had Nexus within that state. Some of the ramifications of filing prospectively are the exposure never goes away. It's still there. It's not absolved even in bankruptcy. There is a risk of perjury for not disclosing the correct Nexus date. Audit issues may come about, as Michael talked about in the introduction. No penalty waivers, and also issues when selling the company. All these are possible ramifications of, not addressing past tax liabilities. Now, fortunately, most states have put in place programs to help sellers address historical liabilities. One of those programs is Voluntary Disclosure Agreement, VDA, which is when a taxpayer, with the help of a representative, can anonymously contact the state with the intention of becoming compliant. One of the big advantages of a VDA is a limited look-back period, usually 3 to 4 years. and also most states will waive penalty. A handful of states have had in the past amnesty programs where the historical liability, the state will forgive the historical liability. And off the top of my head, Tennessee is one of those states that I can think of. Illinois had one for a limited amount of time, but I don't think it's still, I think it's expired since. A third alternative is to register from the Nexus date and file the return to bring you current. Also, in this third alternative, the register and file, you can request penalty waivers. So there are definitely different avenues in handling historical liabilities, and we definitely don't recommend ignoring them. One, they never go away, and it just leaves too much risks for a company.
Thank you. We are up to our third polling question. If you will get the poll open there. Yeah, so companies can source sales to a particular state by simply checking the customer's ship to or bill to address. That's all that's necessary in dealing with technology sales or software sales or services. Just check off where something was shipped to or billed to. That's the answer you need to figure out where something is taxed. True, false, or not sure. Those are your options there. So, and we've looked at some of the amnesty programs, some of the VDAs. Nellie, those are frequently used when you've got a number of years of exposure, and can really use that audit protection and limit the look back period. Maybe the file and register if you are looking at a shorter period of exposure. Would that be a general rule
Correct.
of thumb?
Yeah, correct. I mean, if the exposure is small and just a few months, then registering filing past return is the best course to go. But if your exposure dates back to 8 years, then it will be best to take advantage of a VDA because most states will, limit the look back period to 3 to 4 years.
Mm-hmm. But a VDA may not work if you've already been contacted by the state or they're on to you. Is that, do I have that right?
That is correct. If you've received a notice or intend to audit, that may disqualify you for the VDA program.
All right, great. Okay, well, we've got polling question 3. We'll give you just another moment to answer that. If you have not clicked on an answer yet, please do so. And then we will move on to our next item. So Morgan, let's go ahead and close that poll and talk about automation and compliance.
Hello, Kathleen again. Time to talk about tax automation and compliance. Okay, so you've determined that you have Nexus in several states and you're in the process of remediating your prior period exposure, so you're off to a good start. Now you also need to determine how you're going to handle sales tax compliance in all these jurisdictions going forward. Maybe the sales tax nexus issue arose in due diligence during a business acquisition or sale, or perhaps you raised the issue yourself after hearing about Wayfair. You've probably been working or maybe been working with an accounting or consulting firm to identify your nexus states and remediate the prior exposure. Your team's time and energy has been focused on those endeavors, getting that all fixed, and upper management's level of commitment is high. So everybody's focused on remediating. When that's done, and your team is left to carry the ball forward with ongoing compliance, how do you do that? Well, let's talk about how. Next slide. The reality of the post-Wayfair sales tax world is that an increased compliance burden on businesses. It's definitely a reality we're going to have to live with as our new normal. Technology businesses are particularly hard hit by these changes because of the unique challenges that we've discussed so far in all of the slides and all of our many topics, as well as the fact that charging sales tax is a relatively new phenomenon for the technology sector. Tangible personal property sellers have been doing it for years, but the technology sector is really just kind of playing catch up with regard to sales tax concepts and sales tax compliance. In a post-Wayfair world, you're collecting tax on in more jurisdictions, which means you need more resources, both systems and people. You have a new risk area to contend with, including the potential burden of state tax audits that take both manpower and present a possible risk of cost to the company. And all of this leaves less time for your team to spend on value-added activities for the business. So you're up against quite a lot. And I think one of your key challenges is to keep upper management and the teams engaged to move forward into compliance with equal energy and attention and make sure things are correctly set up. So what you should do, what should you do? Well, first of all, determine the following now while upper management's focus and commitment level is still high, as I mentioned. Ask yourself, should I create a manual process or automate? You're going to need some sort of a process. Is your billing system able to calculate sales tax? What are the shortcomings that need to be addressed in your billing system and the way that it captures and processes data? Does your ERP or billing system correctly source the sales? Think about all the things we talked about in the sourcing section and whether or not your business's systems are capable of handling these issues. Think about things like the manual invoicing and the multiple lines that might come from multiple points of use. How would you go about that? Where do you obtain tax rates? There are approximately 9,000 state and local taxing jurisdictions in the U.S. Some states apply just one state and local rate. Others apply many. Others have home rule localities that have their own tax returns and their own rates. Where are you going to get these rates? Should you buy a third-party system? Do you have sufficient staff resources? Are they sufficiently trained? Should you outsource your sales tax compliance? All of these things are issues that you're going to have to wrestle with in order to get your sales tax compliance process up and running on an ongoing basis. Some companion issues to consider include what risks are associated with not automating certain processes, for example, rates or taxation, and what are the potential workarounds for system limitations that you do identify during your analysis of your system capabilities. Well, let's talk about a manual process versus automation. Let's take a minute to look at each of these and try to do kind of a pro-con with regard to each. Well, when would you use a manual process? Well, a manual process involves using your existing accounting system functionality to add sales tax to customer invoices and to capture the data for the monthly sales tax returns after charging sales tax. It typically involves manually updating sales tax rates, jurisdictions, and taxability based on research or the upload of a tax rate database or some combination of the two. So when would a manual process be appropriate? Well, it might be appropriate if you have Nexus in only a few jurisdictions, only a few states with few or no local taxes or separate local tax rates. You have a limited number of customers with infrequent customer turnover, so you don't have a lot of different jurisdictions to set up. And you have dedicated staff who can manage the sales tax processes and are knowledgeable regarding the sales tax rules applicable to your products. If those things are true, then maybe a manual process is something that you want to look into and using your ERP system and its current functionality. Automating via a commercial sales tax product may be advisable if you're registered and collecting in several jurisdictions, you have multiple product categories, particularly the type which have taxability that's evolving, and therefore would need to continually update the taxability of those products, which you would need to do manually if you were on a manual system. So you would probably want to consider it an automated process, or if you lack internal manpower resources to manually maintain the sales tax processes. So in other words, if you have volume, if you have complexity, or you lack resources, human resources to handle sales tax manually, then you want to consider automation as an alternative. Another significant consideration for automation versus manual process is whether your current accounting system is capable of handling sales tax or capable of producing the type and level of data that you need to send to the sales and use tax software. The last thing you want to do is purchase a commercial sales tax software product and then find that it doesn't interface well with your accounting system. So you want to do your homework there as well. You'll need to evaluate all of those aspects and do a cost-benefit analysis of automating versus implementing a manual process. So to take the external software versus ERP manual process to the next level, let's talk about the nuts and bolts of each of these. How does an automated process with sales tax software work? And what native sales tax functionality does your accounting system likely have if you don't want to purchase sales tax software? When using your accounting system sales tax functionality, typically you must manually create and maintain a table of sales tax rates within your accounting system. Invoicing personnel must manually enter the product's taxability when creating the invoices. Your accounting system then looks up the ship to address from the invoice in the tax rate table and applies the associated rate to calculate the amount of tax due. A commercial software product, on the other hand, includes tax rates, jurisdictions, sourcing rules, and product taxability, and which are maintained in the software, and it bolts onto your accounting system and sends data back and forth between the two via remote function call. Sarah, are we still good? I saw the polling question come up.
Yeah, we're getting to our limit on time, and I want to get to Lauren to let her talk about what's next. Is there an area in exempt sales and exempt certificate management that you'd like to point out before we move on to Lauren's section?
Yes, one quick thing. Exemption certificates are the #1 cause of sales and use tax audit assessments. Taxpayers often are under the mistaken belief that they can go and get certificates when the state comes knocking on their door for an audit. But keep in mind, your customer may be out of business. You may not be able to get those sales tax certificates, and then you are left with a large audit assessment because you can't produce the certificate. So have a process up front and make sure you obtain exemption certificates from your client if you're making non-taxable sales. Back to you, Sarah.
All right, thank you. Lauren, now that we've had the last poll, our fourth polling question up, hope that you guys saw that, but Lauren, talked about what to expect in 2020 and what we're looking at going forward.
Sure. Obviously there's just so much that we can talk to because it's a very complicated industry, and we really expect a lot of continuous evolvement, this year and in the coming years. And I think the first thing is going to be a continuous refinement of economic nexus. So far, we just about have every state on board with economic nexus. There's a couple states that are still the last holdouts, but they are going to get economic nexus in place. And then I think we're just going to see some refinement, maybe upping the sales thresholds, eliminating the transaction counts, and just kind of a settling in, because the states are so quick to jump on the bandwagon. Now they're really seeing how it all plays out and really what's the most effective, to achieve the revenue goals that they're looking for. Second, we're going to see an evolution of a marketplace. And again, most states have adopted marketplace facilitator laws in place. And I think this is an area that tech companies really need to be mindful of, especially if they are bringing buyers and sellers together. The third area is states' enforcement of everything that's going on. We're going to see states really start drilling down on what companies put as their economic or their nexus effective dates on their registrations. I think we're starting to see the Department of Revenue's flag some of those questionnaires and really start some enforcement in that area. And we're also going to see some liabilities for for companies that did not register or did not begin collecting tax when they had that legal obligation. We'll also see some cross between different tax types. So if you're paying sales tax but not income tax, there will likely be some red flags as well. And I think data analytics just within the Department of Revenues, within one Department of Revenue, and also sharing data between different states will play a key role here. More and more states are going to broaden their tax base and start taxing more electronically delivered products and services. Maryland and Nebraska already have bills that propose sales tax on digital advertising. Rhode Island has proposed legislation to expand SaaS. Kansas is seeking to tax more digital products and subscription services. And, we're just in February, so we're going to see more and more of these states, expanding their tax base through taxing technology products. Hopefully, we will see simplification for collecting local taxes. Maybe this isn't an expectation, but wishful thinking. But for remote sellers, and that's especially technology companies, collecting local taxes can be very problematic in states that have home rule cities or local jurisdictions that administer their own taxes. And then hopefully we'll get some additional sourcing guidance. As Kathleen mentioned, this is a very complex area. And as the digital economy rises, we're going to see more and more regulations and cases surrounding this area, especially when the location of the buyer is unknown. So lots of good things coming, lots of different ways that this sales tax impacts technology companies, and different things that you should think about now is, kind of the very first step is, looking at your Nexus footprint. Do you have Nexus? Where do you meet physical presence? Where do you meet economic presence? If you have Nexus, you got to figure out which of your products and services are taxable. You've got to register. You've got to deal with the prior liability if anything exists through remediation. And then you got to put the systems in place to start collecting tax. And if you don't have Nexus, it's not a check the box, we're done. Again, these Nexus issues in the states are continuous to refine. So you do need to be monitoring and keeping abreast of what's changing and keeping current on tax laws.
Great. And as always, if you have any questions, I think we're out of time and I want to be respectful of the top of the hour. So thank you all for attending today. Lauren, Kathleen, Nellie, and Michael, thank you for your comments today. As you can tell, we can barely squeeze in the information into an hour's presentation that we want to share with you. And we've got a lot more knowledge and experience we'd like to get to. But thank you for joining us today, and we will have a copy of this presentation video on our website, and you'll receive a link to it if you'd like to view it again or invite someone else in your organization to view it. And of course, check out our Cherry Bekaert sales tax website, which stays fresh with information on various states and as these rules change and develop. So again, thank you for your attendance today. And if we did not get to your questions, we'll get back to you after the presentation. Thank you all.